Hello guys, so this is not purely a trading related video. Rather, it is a kind of fundamental analysis of our market. See, one of the biggest questions that every investor and a trader at this point have in their mind is where could Nifty be trading by December 2026? See, we have seen 2024 September Nifty touched all-time high of 26,300, and from there we have seen a correction of almost 15-20%, and it came to 22,500 levels, and then again it went and touched that all-time high of 26,400. They made a new high, and then came this geopolitical tension and came down to 22,800 levels, again 23,800 levels. Now it is trading at 24,000. So it's just stuck in the range of 23,800 on one side and 24,200 on the other side. So see, some people believing that Nifty can easily reach 30,000, and some thinking that 24,000 Nifty may struggle in between 24,000. But what I feel is, from 2024 to now, for the last 2 years, Nifty have not given any return. Even if we consider from Jan 2026 itself, right now it is 10% down. So I'm not expecting Nifty is going to go beyond that all-time high, which is 26,300. And I'll discuss all the reasons, all the possibilities. In fact, if Nifty want to go to 30,000, I'll discuss that scenario also. And if Nifty struggle at 24,000, I'll discuss that scenario also. And what case if Nifty can go between 24,000 and 26,500 level also, we will be discussing. The reality is that, see, nobody can accurately predict where the market will be, in the 6 months from now. Maybe if I want to talk about 1 year, 2 year, 3 year, then I can predict easily, right? So instead of predicting things, we will look at the valuation framework. So that is exactly what we will be doing in this session. So rather than guessing one number, whether it is 24,000 or 26,500 or 30,000, we will understand the different market scenarios that can unfold, right? Based on that, you will be able to interpret whether it is going to be there in 24,000 itself, and then in that case, fixed deposit is better, or it is moving to 26,300. In that case, at least some 10-12% bounce you can get. From there also, there could be a dip, even if it is consolidating. Or what are the scenarios where it can move to 30,000? All these I'll be discussing, and then accordingly you can plan. So watch the video fully. I'm sure that you'll get some very good knowledge from this session. Okay, so let's look at these scenarios: the corporate earnings, market valuations, global liquidity, microeconomic and macroeconomic conditions, and geopolitical development. So by the end of this lecture, you will not only understand why Nifty, where Nifty could be trading by December 2026, you will also understand why it is going to be trading in that particular area. So two drivers of every market. Before discussing the targets, let's try to understand one simple formula. If I need to discuss the drivers of Nifty, it is earnings per share, EPS, and the simple equation is Nifty equal to EPS multiplied by PE. This is probably the most important equation in any equity valuation. So the index move because only two variables, right? First is corporate earnings. Second, the valuation investors are willing to assign to those earnings. Everything else, if you look at oil prices or interest rates or monsoon that is going to hit our economy harder in the coming sessions, FIA's flows or geopolitics or US elections or crypto crash or gold or whatever, these ultimately influence one or both of these variables. And once you understand this equation, that EPS multiplied by P, that is actually Nifty valuation, right? Then if you can understand this, then the market movements begin to make much more sense for you. So let's understand the Nifty's valuation story. Let's now look at how valuations have behaved over the last few years, right? Let's understand the pattern. We'll ignore the extraordinary COVID boom and that bust phase that we have seen post-COVID. See, Indian market have experienced two distinct valuation environment after that. The first one, that's the premium valuation, I would say, that during the earlier phase, Nifty traded close to PE around 24.2 because investors were extremely optimistic. I'm talking about post-COVID, and that boom was over after that. The environment was supported by strong FIIs inflows, abundant global liquidity, right? Because after COVID crash, interest rates has also came down, liquidity is injected, so stable macroeconomic conditions were also there, and high confidence in India's long-term growth story. So investors were willing to pay that premium for future growth, and this is what valuation expansion looked like. Then comes the next phase. There you see some kind of valuation compression. The second phase actually looked different compared to that. You got some strong rallies also. Even during strong rallies, Nifty struggled to trade beyond a PE, which is approximately 22.9, because global conditions have changed by this time. Interest rates have moved higher. That post-COVID advantage is not there, and then liquidity becomes slightly tighter. A kind of quantitative tapering have happened, and geopolitically also uncertainty have increased. Ukraine issues, right here, Russia-Ukraine issue, and when money becomes expensive, investors become selective. So instead of paying that 24 times earnings, they become comfortable paying 22 times or even lower. So during corrections, what happened? Valuations compressed further. That came towards approximately 19.8. That moment, that time I told you, right? Nifty came to 22,000, 21,800, 22,000 level. At that point of time, 19.8 P. And at that point also, I told you, this also is a better PE. If you see the correction at that point of time, it is better. Therefore, if you see over recent years, the practical valuation, the upper band and lower band, if you see this period, 19.8 was the low and 22.9 was the high. And this becomes the foundation for the analysis that we are going to do now. The future market possibilities will keep this in mind. So I hope you got this initial case we have seen till 24, and the second phase we have seen 19.8 was the lower band of the PE, and upper band is around 22.9. Now, if you see the current valuation position, at present the market is trading close to a trailing PE of approximately 20.5 to 20.8. So what does that tell us? The market is not extremely cheap also, and market is not extremely expensive also. It's not at the higher band, it is not at the lower band, it is in between. So valuations are actually appearing moderately or broadly fair at this point of time. And that means the next major move will depend far more on earnings rather than valuation alone, because valuation at this point of time looks broadly fair. Now, why earnings matter more than PE at this point of time? See, many investors focus only on the PE ratio. That's actually a mistake. Remember, price is only part of the equation, right? Earnings are equally important. Imagine a company earning 100. Analyst is expecting earnings to rise 115 next year. So instead, earning increase only by 103. Suppose the earning is 100. We are expecting it is going to be 115, but it is grown by, let's say, 103. Even if the share price remain unchanged, the valuation become much more expensive than investors originally expected, right? So now imagine this is happening across hundreds of companies inside Nifty. That's exactly what the market experienced over the last 2 financial years. Financial year 2025, what was the expectation and what was the reality? At the beginning of financial year 2025, analysts were expecting the earnings growth nearly 15%, right? That means if it is 100, it should move to 115. But what was the actual growth came, which is approximately 3.4. That's a massive disappointment. Financial year 2026, if you see so far, the same story again. Expectations were around 12 to 15. Actual earnings, the growth remained around 4.5%. So for 2 consecutive years, the expectations remained so optimistic. But if you look at the actual earning, that stayed below 5. That stayed even below 1/3 of what is actually the expectation. So that gap between expectation and the reality, the real what is expected and what came in the actual, that explains why valuation, has become very difficult also. Now, why this earnings are underperforming despite this kind of expectation? This is not the problem restricted to just not one sector. Weakness we have seen appeared across multiple industries, and there are multiple reasons also. So see, immediately after COVID, there were a lot of government capital expenditure, right? When we talk about government expenditure, there can be revenue expenditure, capital expenditure also. Capital expenditure is going to be very good for the market. So post-COVID, after that phase, the government capital expenditure have came down. And also, if you see weak urban consumption, that is one reason. And then margin pressure across several sectors, that's there. Banking earnings are also below expectation. Automobile demand is also slowing down, and pharmaceutical companies also missing that optimistic forecast. And that is actually telling us that earnings are slowing down, and that is not only connected to one sector, across sector, and it is broad based, and there are multiple reasons also, right? Now, one thing for this analysis, what we need to understand is the forward PE. There are two types of PE. The trailing PE, I told you just before, that uses the previous 12 months earning, and forward PE. See, that is basically using, as the word itself is telling you, right? Forward. That is the expected future earning. The one which we are talking about, trailing PE, that is using the previous 12 months. Okay, so see, forward PE, in fact, will actually tell you that what market expects, right? Not what actually happened. Trailing PE will tell you what happened in the last 12 months. Forward PE will tell you what market is actually expecting, and that is making it, in fact, one of the most important valuation tool also. So forward PE is also very important. Now let's look at different scenarios. Suppose financial year 2027, if that is again going to deliver growth only around 4 to 5%. Just like 25, it's around 3.5. 26, we have seen it's around 4.5. Now, financial year 2027, if we take 4 to 5%, in that case, what will happen is the forward PE would remain close to 19.8 to 20. See, historically, average forward PE has been closer to 17. So if that remains close to 20, that means valuation would still appear somewhat expensive, right? So the historical PE is around 17. Now, financial year 2027, you are expecting that it is going to be 4 to 5. Then if it is 19.8 and 20, still it is expensive. I hope you understood. If you're considering it historically, that means valuation is slightly expensive. In such kind of environment, what market will do? Market will struggle to move significantly higher. So there is a reasonable bearish scenario that would place Nifty somewhere around 24,000 to 24,500. Correct? Now, scenario 2 is the case of moderate recovery. Now, suppose earning begin to improve. Let's say growth recovers towards approximately 8 to 10%. And there are other conditions also, like inflation remains under control, oil prices softening, coming down, and the monsoon performing well. There is a problem with monsoon actually that we'll be discussing separately. And then what happens is the forward PE ratio, the PE becomes more attractive. And that create room for gradual market appreciation. So under such condition, Nifty can reasonably move towards 26,000 to 27,000 range. That is what I told you, the all-time high which we have seen before. Even in that scenario, market will be giving you the same return that we got in September 2024 after 3 years. Now the scenario 3, that is a strong earning recovery. So entire point is depending upon the earnings, right? Not just valuation. Now consider this is the most optimistic environment. Corporate earnings return to double-digit growth. And also the other condition, FII inflows coming, rupee is stable, oil is stable, and global uncertainty is also reducing. Then investors once again become willing to pay higher valuation multiples, right? This is how actually PE expansion happen. And when both earnings and valuation improve together, the market can witness a powerful rally. In that scenario, Nifty could potentially move towards 28,000, 29,500. Now you think about it. What is most likely to happen in the three scenarios that I've discussed? 2025, the growth is around 3.5. 2026, it's around 4.5. Now, if it remains 4 to 5 range, we are not going to see any change even from here, 24,000 to 25,000 itself. If it move to 8 to 10%, then we will see that we are touching that previous high, swing high, which Nifty have made, that is 26,500 level. If it goes further, double digits like 13%, 14%, 15%, as expected last year, then only we will see a scenario where Nifty is closing 28,000, 29,000 level. Now, there is a very important factor which is going to affect us very badly. That is a monsoon variable. One of the macro factors that deserves close attention is this monsoon. Nearly 60% of Indian farmers depends directly on rainfall, right? And weak monsoon is what is actually forecasted this year. So if there is a weak monsoon, that is going to affect so many, right? Like rural income, rural consumption, FMCG sales, two-wheelers, tractors, rural financing, everything. Ultimately, weaker rural demand, that becomes weaker corporate earnings also. Therefore, the monsoon is not merely an agriculture issue. It is also an earnings issue. So the monsoon is something which I'm sure that it is going to hit hard on our market, especially this year. And the visibility will be like after 2 quarters, not now. Now, again, global liquidity also cannot be ignored. What we are going to see as per the Fed decision is we are going to see interest rate hike. And many investors believing that Indian market move only because domestic fundamentals. That is not correct, right? Indian equities remain heavily influenced by FIIs inflows. That's when the market rallied. Now, why the market is not moving anywhere? FIIs are going. So FII flows is important, US interest rate is important, dollar liquidity is important, rupee strengthening is important, global risk appetite is also important. And when liquidity is abundant, the valuation generally expand. And when liquidity tightens, that is when valuation compress. For example, Fed tapering is coming, then it tightens, right? That is a tight money policy. The interest rate hike, then valuation compress. When quantitative easing is there, liquidity is abundant, then valuation generally expand. That's when the market rally. So ignoring global liquidity means ignoring one of the biggest drivers of equity market. So a lot of things, oil, gold, monsoon, FIIs, interest rates, geopolitical tension, and US political development. This is another important variable, very important political environment. Uncertainty reduces after this midterm election, then the global investors may once again become more willing to invest in emerging market. So if uncertainty is reduced, that can support the valuation expansion even without dramatic earnings improvement also. So that is also another factor. So these are things that you need to keep in mind. So rather than trying to predict the market every day, you can monitor 5 important variables. First, corporate earnings. Are the EPS estimates are improving or not? Second, the valuation. Is the market willing to pay a higher PE? Third, the crude oil price. Very important. From the geopolitical tension is rising, I'm talking about this every day. Lower oil supports India's macroeconomic outlook, inflation, interest rate, everything that is connected. Fourth, FIIs inflows. Are foreign investors are returning or not? Now, fifth is something which is mostly underrated, underestimated, but this year we are definitely going to see its impact. It is going to hit hard: monsoon and rural demand. These 5 variables together, they provide a much better indication of where the market could be heading. So the 3 possible outcomes I've told you, right? The bearish case, the conditions is that earnings remain weak, PE remains around 20. So historically, if you compare also, that is slightly expensive. So the possible range in that case will be 24,000 to 24,500 because earnings remain weak in the range of 4 to 5, as what we have seen in 2025, 2026. In that case, even if you take forward PE, that remains slightly expensive. So chances very less that it will move higher, right? So it will remain in this range. Neutral case, that relatively moderate earnings recovery, like 8 to 10. And also, monsoon is very important. Crude oil price is also important. Geopolitical situation also need to be very important. In that scenario, 26,000 to 27,000. We have seen the all-time high so far, 26,400. Same high we have seen in September 2024 in the big rally. So that is what we may be seeing in September 2027 also. Who knows? In a neutral case, if everything is neutral, if global uncertainty is not there, if monsoon is fine and everything is fine, moderate earnings recovery is also there. Now the bull case, the best case scenario, everything should be going good. Earnings growth should be strong based on the expectation. Now, the expectation and reality is different. Expectation was 15%, reality was 3.5. Expectation was 12% in 2026, reality is 4.5. Now it has to go to 12 to 15%. So earnings should be strong, valuation need to be higher, FII inflow should come. Now FIIs is going, and global sentiment need to improve. Political environment in US need to improve. Interest rate should come down. In that case, Nifty moved to 28,000 to maybe 30,000 points. So see, market do not reward people who make bold predictions. You can make a prediction and you can tell that, hey, went wrong. Market actually reward people who understand probabilities. So instead of asking, where will Nifty be by December, you need to start asking what conditions are developing today. Because when you understand earnings, valuations, liquidity, macroeconomics, you stop reacting emotionally to the market and you begin analyzing it like a professional. And I want you to be like a professional. I am a professional and I teach my mentees also to become a professional rather than, a random gambler. Some of them will become professional, of course, many of them won't. That's a different case scenario. And that shift in thoughts and thinking, that is what's separating the successful long-term investors from everyone else. So that's it, guys. Thank you so much. I see you in the next video. If you're looking for any live market mentorship for the trading sessions, you can join our community, talk to our team. See you there. Thank you.